Welcome to Adding Value with Assar, the show where we dive into the stories, strategies, and market insights shaping the world of industrial and logistics real estate. In each episode, we sit down with industry leaders, investors, developers, and tenants to explore their journeys, unpack current market trends, and share takeaways that can help you better understand and navigate the business. You guys can work through this, right? Like you can
screw up all you want. You can screw up all you want. You're doing real well on this to start. So I see things being positive going in.
Well, it means good news for all of us.
I hope so.
Yeah.
If not, you can roll back the tape and yell.
Yeah, that's right.
I would say a common trait and something for young people or new people in the industry to think about for successful brokers is the ability to listen.
Value creation is not just about the numbers and the financial stuff. It's about creating value for our customer.
I remind myself, like, this is the business we got into. The business of what we got into.
Yeah.
The prerequisite was that you just don't give up.
We having the Kelsey brothers on next time?
Maybe. Who knows? Today, I'm excited to welcome James Hwang, Vice President of Acquisitions at MDH Partners. MDH is a real estate private equity firm with a focus on industrial and logistics assets. The firm has done over $7 billion in acquisitions, developments, and asset management, and currently operates from a portfolio of about 35 million square feet across 33 markets. MDH recently acquired a major industrial asset in Ontario right near the airport, and that transaction was brokered by Mike Hefner of Voight Real Estate Services. James has a unique vantage point, both as an institutional acquirer and as someone with direct exposure to the Southern California industrial market. We'll discuss his journey, investment strategy, what they look for in deals, and how the major players approach Southern California industrial. Welcome to the show. So taking it from the top, James, thank you for coming today. What I think is really cool about our kind of our friendship and our working relationship is I remember when you had first started at Rexford or really kind of taken over the IE as the market lead. And I think that was probably in the late 17, 18.
Yeah, so I officially started at Rexford in 2016 in May. And then I want to say late 2019, I was officially took over the Inland Empire at San Gabriel Valley as their market lead. And so I know we had probably talked and met before that, but that's when I officially really took the reins over. And that's how we met and I actually remember our first real intimate interaction was I got in your car. Yeah. We met in Chino because I know that was your stomping grounds when you first started. And we literally drove through the market
looked at buildings,
and we just sat together in your car as you drove around, and that was an awesome experience. And just the first step of our really good friendship.
So you were at a position where you had just taken over as market lead, and then I also was at a place in my career where I was really trying to kind of transition a little bit from doing only owner-user transactions and start working with institutions such as, Rexford.
Yep.
And so it really felt like a right time, right place for both of us as our careers kind of intertwined. And, it was a start of a friendship, a start of a working relationship. And we tried really hard on a number of deals. And we finally closed a pretty big deal in Chino off of Benson in 2023, was it? Or 2020, it was like March? I think it was
2023, yeah.
2023. So appreciate you coming today. Appreciate your relationship. And really for the folks who may not, know you and know about your background and know about MDH, the company you're with right now, can you tell us a little bit about your story?
Yeah, so my story is very interesting. I mean, I graduated from USC, and I feel like most people are so polished coming out of college and whatnot. And honestly, I was the least polished guy coming out of college in 2012. Mm-hmm. I remember, I didn't have the deep roster of internships with big level companies. I really, for me, I think it's an interesting story. It's, my parents are immigrants and whatnot, and all they knew really was to get your kids into a good college. And obviously there's your standard occupations like a doctor, lawyer, businessman, things like that. But I mean, all they knew was to get people into your children into a good college. And after I got into college, I chose to do business because it was going to be the most broad degree, really. But other than that, I didn't really have any insights of what there was outside of college. So I remember senior year, winter break, my mom asked me, what are you going to do in May when you graduate? And that's the first time I really thought about what my undergrad life was going to be like. And I realized I didn't have a job. I wasn't doing any interviews. So I remember starting second semester senior year. I started asking people what they were doing, and a good portion of my friends already had jobs. They got their jobs first semester. A lot of these guys were in investment banking, things like that. And I'm there like, oh my God, I haven't done anything yet. Mm-hmm. So from then on, I started to try to figure out what I was trying to do. And just kind of looking around, I ended up getting an offer to work at a residential mortgage servicer down in Irvine, luckily, and I secured that job in April, and I was supposed to graduate in May. So I started working there on the residential mortgage side in the loss mitigation department. Eventually, as I was working, I really figured I wanted to do some kind of level of commercial real estate. I didn't know at the time it was going to be industrial for most of my career, but I knew I wanted to do something in commercial real estate. So eventually I started working for a company in Century City, doing much more generalist appraisals and valuations for all asset classes. In 2016, I had an opportunity to work at Rexford Industrial. So that's how
it was on the come up.
Yeah. So and I started as an analyst at Rexford, and eventually operated in being a market lead in the San Gabriel Valley, Inland Empire West for Rexford. And spent a lot of great time there, and ultimately after about 7.5 years, had an opportunity to work at MDH Partners, and so that's been my trajectory and path to get to MDH. So I've been at MDH now for a little over a year now.
And so you've been at MDH for over a year. You're essentially the market lead for MDH on the West Coast or Southern California?
Yes. So MDH Partners is based in Atlanta, Georgia. There's another office in Dallas, Texas. I was hired to open up the Los Angeles office and West Coast presence.
You guys just recently closed a big deal in Ontario.
I did. Yes, we did.
And tell us a little bit about that deal.
Yeah. So Ontario Commerce Park 2, we bought that through Mike Hefner at Voight. Love the Voight team. Great group of professionals over there that I've always enjoyed working with. And so actually back in my Rexford days, I remember chasing that asset back in 2019, so at that time, TA Realty bought it.
TA Realty bought it how many years ago?
In 2019. They
bought it in 2019. Was it partially vacant at the time?
At that time, I think there might have been a vacancy or two.
Or under market rents, maybe, because they had a business plan that they executed.
Yes.
Right? So they bought the asset in 2019. Do you remember for how much?
Oof. I want to say it was like $130 a foot or something like that.
So bought it for about $130 a square foot. They likely, did some improvements to the property.
Yeah.
At the same time, they rolled some tenants to market, so they increased some rents. And then if they had some vacancy, I do remember there was some vacancy, so they had some new tenants being put into the property as well. They fully essentially stabilized the property, right? Yep. If I'm not mistaken, you bought it today,
yep.
Fully leased, rents are for the most part at market.
Correct.
Okay. And then they brought it to the market for sale.
Yep. And
then you guys purchased it through Mike Hefner.
Yep. Okay. So had another crack at it. And what I really liked about that project, it's on Main. It's a main location in Ontario.
It's right by the airport.
Yeah, you have Ontario Commerce Center, which is a big master planned industrial development that the city of Ontario did, and they've had the foresight of creating this area for industrial uses. And you're close to all the major infrastructure, the freeways, the airport, the rail, BNSF and Union Pacific, and being in that location off Milliken, for us at MDH felt like a really important flag to plant in Southern California, and just show that we are really, really serious about focusing on not only the Inland Empire West, but the infill locations in Southern California. And that project, the thing about those kinds of buildings, it's multi-tenant industrial. and they're so difficult to build and replicate in today's environment. Just construction costs, high cost of land. There's a lot of entries to barrier for that kind of product type. And what we've seen is actually in the past 5-10 years, the inventory in stock for multi-tenant industrial has either stayed relatively flat or has even decreased. Most developers today are focused on cost efficiencies, and cost efficiencies mean you're building generally single tenant buildings.
Bigger stuff.
Yeah, bigger stuff, single tenant, because the cost to demise and have multiple office pods and demising walls, plumbing lines.
It's a management nightmare, isn't it?
And management too. It's just so costly. And what ended up happening is all the land prices out here, it really became optimized for single tenant occupiers and single tenant developers, or people that are designing buildings for single tenants. So in general, it never really, where land prices are, it never penciled for speculative multi-tenant development. So with that being said, we feel very strongly that it's an irreplaceable asset, and that we're buying it substantially below replacement cost. I mean, I think to replace that today would be upwards of $300 per square foot, and we bought that asset for $224.
So on the topic of that, so the profile of the deal, so I understand the profile of the deal, but on the finance side, you said $224 a foot. What is the ingoing yield?
We're going at 100% leased at market rents, and we're going at about 6.2 cap rate.
Okay, so you're getting a good return on the asset. And then what is your folks' business plan? How do you guys, just for, pulling a layer of the onion back, how do you guys look at deal business plan and exit strategy? Is this a long-term hold? Is this...
Yeah, so at MDH, we always look at things on a long-term basis, but in general, we underwrite to about a 5-year underwriting hold period. But I think what the really good thing about MDH, it's a seasoned group of industry veterans that really understand industrial real estate. And what we are seeing here is that, and taking a step back, as real estate is so cyclical as we've seen, we always try to look at optimizing our best risk reward strategies. And so this one fit that bill because we have a leased asset, buying it substantially below replacement cost, where we feel like there's going to be tremendous pressure upwards on potential value creation because of just the scarcity of this kind of product going forward. And still there is high demand for a product like this, and in a very infill location where we feel really comfortable. I think ultimately, while there has been some softness in industrial, when you look on a 5+ year horizon, you feel really good about buying something substantially below replacement cost.
Absolutely. So the goal is you guys are going to hold it long term?
Yeah, and so at MDH, we like to, we're opportunistic. So we'll, depending on where things flow in the cycle, we'll evaluate it. But we have a longer runway than other groups to be able to look at things.
So we hear that word a lot. In our business, it took me a while to start understanding essentially the lingo that comes with institutional investors. For those who may not necessarily know or have familiarity with, when somebody says on the principal side, I'm looking for a value add opportunity, or I'm looking for an opportunistic opportunity, or a core plus, can you kind of take us through that life cycle and what that kind of looks like and maybe provide some examples?
Yeah, I think there's a lot of people out there that is in the value add category, right? I think the simplest way people look at value add is you have a vacancy or empty building and you lease it up and you create value that way.
So walking through, it's like almost like if I'm an investor and I'm looking at, and the value add can just be anything as far as repositioning the property to some form to increase the value.
Yeah.
Right. And a simple way to say is like if I'm able to buy a building that's vacant, and because it might not necessarily be attractive to another investor because it's sitting vacant, but I can buy it cheap. Let's just use numbers, for example. If I can buy the building for $130 a foot or $150 a square foot and it's vacant, and I can kind of make some improvements, landscaping, paint, new lights, dock packages, asphalt, and then I take on the vacancy risk and I go to market and I hire some great brokers from Voight Real Estate, and they lease the property for me, and they get a really strong rental rate. I, as the investor, as the value-add investor, came in there. I risked my money. I spent about a year's worth of time. I ended up paying people to help me with this project, and maybe I bought it at 150. My cost basis went up to 180 for argument's sake. But now, given where the lease rate is at with the lease in the building, I can turn around and sell this building for $240 a square foot, right? And so the value creation there is really the difference between 180 and 240, and that's quote unquote falls into the bucket of a value add strategy. Yeah, would you say that's a fair statement?
Yeah, and I think that's I think there's a lot of different ways to skin the cat when you're looking at value add, and for like the simplest would be like that kind of example there. But I think there's a lot of ways to create value. And to me, the way I look at value creation, it's not just about making money or increasing value numbers wise. I think you have to provide, believe it or not, we are in like the customer service industry.
Tell me about it.
Because it's not just, we have to service our customers. We have customers. It's our tenants. And to me, value creation is not just about the numbers and the financial stuff. It's about creating value for our customers. We really want, if you're coming into the MDH ecosystem, we want to give you the best service, whether it's through asset management, property management, making sure that like creating value for our customer end user. And that also includes making sure that if we're trying to increase value for them, we got to provide them the best building that possible for whatever whatever class asset you have. And sometimes that's repositioning, whether it's cleaning up dilapidated offices, trying to add some loading. I recall for example, there's a deal that I worked on in the past. There was a deal in Ontario at 60,000 square feet. Building was built to lot line, really efficient use of the space. Built in the late 1980s, and so it only had four dock high positions, and so that narrows your depth of users down quite substantially. And the repositioning plan on that one was to add another 6 more doors to get to about 10 positions for a 60,000 square foot building.
Is that about the right ratio? About 2 to 1?
I mean, most people I think the general rule of thumb is to have 1 per 10,000 square feet. But I think actually in that instance, we were planning on adding 8 doors to get to 12 dock doors. So that would be 1 per 5,000 square feet, which is really, really high dock count, and could be used for just a standard distribution guy. It could be used for a transloader, people that are looking to turn space really quick and need a lot of dock positions. So that would be a significant, you're creating a lot of value for a lot of other customers.
You're changing the property.
Exactly.
So yeah, so to add on what you're saying is you're saying that essentially value creation comes in the form of just changing the if you have the ability to change the property, like if it has excess land. Another example would be, hey, is there a way we can figure out how to pave this land and turn it into a secured yard, and then charge rent for it, for example, or for the benefit of the tenant?
Assuming that the tenant is extracting value out of that. And the whole idea is that I want them to do really, really well, because that creates value for us. And
for sure.
So I feel like if you're focused on delivering the best customer experience through and creating value for not just them, and this goes to, it requires a team, and it requires great people that we work with, including brokers, yourself, other people in the industry. I really do feel like you get what you pay for. And I mean, there's another instance of value add is in the industrial world, as you know. Obviously there's the institutional owners, but then there's a lot of mom and pops, family ownerships, private family ownerships, and some of these unsophisticated ownerships either just have a lot of deferred maintenance on their properties. They're implementation of management and leasing is very, very unsophisticated. And so if we were to come in and purchase, like there's instances where an owner of a property, let's say the parents actually ran a business out of an industrial building, they retired, they ended up leasing it, the kids take it over, it's become a management headache for them, they don't want to deal with tenants, vacancy, deferred maintenance, things like that. That's where we can come in and extract value by implementing operational efficiencies, implementing professional management, implementing professional leasing, and having the having the capital to turn this project from what looks like a B- maybe into B plus, and then also with all the operational efficiencies, create value that way.
So for folks who may not understand, so there's essentially classes of buildings in the industry, how you rate them, right? There's an A class, and there's a B, and then a C, and then when you say B-, you're saying a building that is in a B- condition.
Yeah.
You guys come into the picture, you add value through operational efficiencies, inject some capital, make the building nicer, overall make it a more pleasant experience for a future occupant.
Yep.
And that in itself would give it an upgrade in grade. You go from a B- to a B+, which in turn means that you get an upgrade in rents as well.
Yeah, because the tenants, hopefully,
Appreciate
our
it.
customers going to appreciate those improvements. It's going to add value to their operations and thus willing to pay a little bit more.
For sure. So on this subject of kind of value creation, and you guys let's hear a little bit more about because you're leading acquisitions essentially on the whole West Coast.
Yeah.
What is your guys' acquisition strategy moving forward?
Right now, it's as we all know, especially in Southern California, it's an interesting time to be. I mean, it's been a very difficult environment probably for the past 3 years. So ultimately, we talk about risk reward and risk adjusted returns. Right now, and it's the big talk is speculative development just doesn't pencil for a lot of people. So looking for land sites, dirt to have new development really doesn't make sense for a lot of groups.
And just pulling a layer onion back again, and that's really because, one, we have a healthy amount of inventory available for lease.
Yep.
Two, the cost of construction is at a point where if you were to put together a plan to buy a piece of land and to build it, chances are your cost basis is going to be somewhere near what it costs to sell the building or what you can sell it for, right?
Yeah. You're saying so it's
there's no profit.
There's no profit.
So for that reason, most developers are not buying land or building right now.
Yeah, because of your construction costs and where rents are today. That could change, obviously, as we know, it could change really quickly in Southern California. It's such a dynamic market. It doesn't take much. I mean, with what's the future pipeline in the Inland Empire, like less than 10 million square feet or something like that. So historically, the Inland Empire would have positive net absorption, somewhere like call it average 20 million a year. And so when you look at the lack of construction coming on, obviously there's still a lot of healthy inventory to chew through.
But you're right. When the tenant demand picks up, we're going to work through that inventory pretty quickly, and we're going to be bottlenecked.
Yeah.
Because development takes 2 to 3 years.
Yeah.
And if we have no inventory, that means that, and to backfill that inventory, that means the prices are going to go up substantially, rather quickly.
Yes.
So it's going to be just as quickly as it swung this way. When it does curve back the other way, we expect ultimately a pretty quick swing also.
Yeah, it could certainly happen that way.
So let's talk about a deal, right? Or we can maybe even use this Ontario deal that you've just recently done. For those folks who may not necessarily see what it's like to do an institutional deal, can you walk us through what happens? So you're bidding on this asset in Ontario. You go through multiple rounds of bids. You win the bid. And where do you go from there?
Yeah, so once you're awarded the deal at MDH, we try to be the best partner there is and so we look at every transactional experience as it's not us versus the the seller. We want to work hand in hand and achieve the same goal, which is to cross the finish line and close on the asset. And we want to say what we're going to do. We're not retraders. I think your word ultimately is a big thing of your reputation, and we stand by a word. And so once we're awarded the deal, we try to operate as efficiently as possible. And to me, due diligence is one of the most important things of buying any asset. Before we jump into due diligence, so on that topic, what were the deal terms that won you guys the asset? Yeah, I mean, for that one, I think our typical terms that we outline is we'll do a 30-day due diligence, and depending on who it is, if it's an institutional owner, we'll try to go off an access agreement to while we work on the contract. So your due diligence clock starts prior to you even signing a contract. Correct. You do a simple access agreement, which is a couple pages, I'm assuming. Yes. You guys sign that agreement, and then you work on the purchase agreement. But right when that agreement is signed, they release all due diligence information to you. Yep. And then, but your due diligence clock starts right after you mutually execute the access agreement. What is, so you guys did a 30-day due diligence. How many day close? 15-day close. And how heavy of a deposit? And the deal size was roughly about $30 million. Is that right? Yes, it was just a hair under $30 million. So I would say your typical deposit is anywhere between 2 to 3%, depending on who it is. And I think for this one, it was somewhere around 3%. But, and so we offered a 30-day due diligence and a 15-day calendar day close thereafter. And so the clock starts ticking, obviously upon signing of access agreement, but also we expect to have all the due diligence information delivered to us so that we can really hit the pavement running. And because it's one institution to another, they typically have all that information, right? Yeah. Right out of the gate, you're not chasing a lease for like 3 weeks. Yeah. I'm assuming you get a Dropbox file or some secure file. Everything gets dropped in there, and you and your team start going through everything. Yep. So, 30 days it's some people, I would say most groups offer between 30 to 45 days of due diligence. And so we try to operate really quickly, efficiently, and our general time frame is around 30 days for due diligence. So what that means is we really kick the tires. We engage all of our consultants, and this goes back to having a really strong network of people. It's not a one-man effort. It's a team effort across many different fields of professions. And so, as I had mentioned, due diligence is super important because you have a finite period of time, and in this case, we had 30 days to try to uncover and make sure all the information, all the leases, building condition, whether it's physical, environmental, all that stuff, were checked the boxes and were no issues to report. And that one I knew we were going to have probably really clean process there because of the institutional ownership prior. Mm-hmm. And obviously it's in a location where you just don't end uses in there are generally just very basic warehouse distribution users. So nothing to worry about really there. But it's not a heavy industrial use. Yeah. And in Southern California, there's a lot of, in general, there's a lot over the past decades and centuries of uses out here. Environmental is a big one. And so making sure that we can hopefully uncover any skeletons is the biggest thing, and making sure that you can execute on your business plan. So you try to set up your team within your due diligence period as best as possible. And in this instance, it's 100% leased, so there wasn't too much to do. But if it was a vacant building that we were trying to do repositioning on, I would be in contact with the city or whatever municipality there is, making sure we can execute on these things at an appropriate time frame, and try to tee it up as best as possible to when we close, we can execute. Because execution, I think, is the most important one of the most important aspects of any real estate deal. And this goes back to your risk management spectrum. Even adding a couple months of delay or cost overruns can really, really hurt your return profile. So To me, and I know you had asked this prior, it was what kind of deals are you looking in today's environment? And it's all the risk adjusted returns are super important. In today's world, I feel like if you're doing a heavy repositioning or redevelopment, things like that, you really need to make sure your timelines are good and your costs are super tight. Because if you miss on that, it's to me, that's a level of risk, that heightened risk, especially in today's environment where leasing fundamentals are, I think, finding a nice little bottom here and finding a way to stabilization. But it could quickly turn the other way if you don't have the right team of professionals that can help execute in your business plan.
Got it. As far as checking all those boxes, as you were mentioning, so you guys do, I'm assuming, a property condition assessment.
Yep.
Right out of the gate. Survey, environmental, you guys, what are the main capital items you guys are probably looking at? The roofs?
Yeah, I would say in general on our property condition assessment, your big capital items are going to be roof. It's going to be, if it's asphalt, there could be that. If you have the condition of the interior is also big. If you have a huge build out of office in there, which most people aren't going to use, that could be a big,
that can be a problem.
Yeah, that could be a big cost item because just demoing and cleaning up that office space, and as you know, replicating office space is super expensive.
Yep.
So I would say those are the big things on the capital front, but it could certainly swing the other way if you have some environmental issues, which
Sure.
hopefully you don't.
And how many tenants were at this project?
There were 9 tenants at that.
So I'm assuming you had to go through every one of those leases, dig through all their financials, tenant interviews, understand the business model, and then you're able to wrap everything up within 30 days.
Yeah. So understanding your tenants is also pretty important. This is why I think tenant interviews is crucial to any diligence process. Being able to speak with your future customers and tenants, how the space is working for them. I think I've heard there's an example that I can remember in my career where we found out that they were leaving, and we hadn't been disclosed of this information prior, and so that changes your outlook on how you look at things, and this is also news to the ownership too, and so
Sure.
it's things to figure out that way. Yeah.
And they were leaving shortly after escrow or something like that?
Yeah, something to that nature. It's been.
So one thing I'm sure a lot of, especially private folks, would like to understand is with large institutions like yourself, or at MDH, the company you're at, how does financing come into the picture?
It's a great question. Because
you guys are closing all cash, right?
So correct. We don't need any financing contingencies. So the way we look at financing is we like to aggregate a few properties, come up with a pool of assets essentially, and it could be 3 or 4, it could be more than that, and we'll go to various lenders and look to get terms,
more efficient terms.
Yeah, because if you have, let's say you have this Ontario asset, another asset in Houston, Texas, and another asset in North Carolina, and when you pull them together, you have a little bit more of a diversified risk spectrum, and lenders tend to like that, and I think they.
And then the bigger the loan gets, you typically get better terms, right?
Yeah, it depends. Yeah, but yeah, it'd be more favorable sometimes. So we don't do asset level. We like to pool things together and get and finance that.
Is that probably within that 1 to 2 year time frame of the asset closing?
Yeah, that's probably a good timeline there.
What is your perspective on where our market is going in 2026, and how bullish are you?
The $1 million question.
Yeah.
Or $1 billion question. Obviously, I think even looking at the past 5 years, I think we'll look at this back when we're decades down in our career and look at that was a very unique point in time. You had COVID and the pandemic that really accelerated industrial in ways I don't think could have ever fathomed. but also the correction coming from that was also something that I think we had some expectations of, but there's been a lot of obviously world events that's happened, and you have your tariffs and trade wars and a lot of things that make it really difficult for businesses to operate. I think once we get a little bit more clarity on how business can operate, whether it's through fully understanding where tariffs will eventually settle down across the country, how supply chains adjust to that, I feel really bullish. I mean, Southern California is such an important part to the infrastructure of the country. You have the two ports, Los Angeles, Long Beach, that if you add them together is the biggest or top 5 in the country, North America in general.
Sure.
And it's an important part of our infrastructure to keep the country running. And so when you look at just the very lack of future construction starts and deliveries, you can have a really, while we do have some inventory to chew through, I think you can make the case that there is some, hopefully, assuming that there's clarity for businesses to make business decisions for expansion and growth. And I think part of that also, with clarity on where the external factors are, I think with hopefully if interest rates come down a little bit, that'll allow businesses to make those business decisions, expand, grow, take on more space, be re-engaged the market, which they have been generally sitting on the sidelines for. And as we all know, this could turn really quickly into a very dynamic and vibrant market for
if I'm hearing you correctly, it just sounds like we're at a time where it's kind of like a perfect storm.
Yeah.
Right. We had that huge surge in values, and then things started to come down, and a number of variables have impacted the drop off in rents. And you're right, because I have talked to a number of institutions, and everybody's got capital. Everybody wants to get in, but there is a sense of hesitation about, when the right time is and when we're necessarily bottoming out. And nobody wants, as I say, catch a falling knife.
Yeah.
But I have talked to a number of groups like yourself that where the majority are kind of conservative and maybe staying on the sidelines, a couple groups are very contrarian and look at this as a great buying opportunity, because what we see is really on the private side, let's say the buildings, let's say deals under $20 million, investment sales under $20 million. Most of that product, say less than 100,000 square feet in the Inland Empire, is owned by private owners.
Yep. And
majority of the private owners, it's their money, right? So unless they have some form of distress in the form of financing and they have to sell the property, most guys just won't.
Yeah.
Right? They'll just turn around and say, if buildings hit $450 a foot, if they're $250 a foot today or $220 a foot today, I just won't sell. Right? Now, what I've noticed is, at least on the institutional deal front range, north of, say, $20 million, a number of those assets were bought 10 years ago. So if somebody sells today at $225, $230, $240 a square foot, well, they bought them 10 years ago at $150 a foot, right? So there still is a spread. So and if they want to return money to their investors, then yeah, it's not at $450, but they're still making their returns. So they'll transact. And so we've seen quite a bit of velocity of deals coming to market and selling that way. And I've noticed a couple buyers are taking advantage of that opportunity because they feel the same way. They feel like we could be bottoming out here. And it might be one of the best times to buy and invest in industrial real estate because, as you said, when it does turn, they're going to be holding some good buys.
Yeah, and it's hard. You can't time the market perfectly. But what you can understand is understanding the fundamentals and seeing where create projections of where things are going to go. And I think one of the issues is a challenge with people with conviction is that it's hard to find a seller right now. Like to your point, these private owners are, unless they're in some kind of distress,
just hold on.
Have no pressure to sell.
Yeah.
And so But on the institutional front, if you're on a closed-ended fund where you have to return your investor capital and it's your fund maturities there, they have the guys on the other side of the institutional side, they know where market cap rates are.
Yeah.
It's
you have an educated seller.
Yeah.
And,
exactly.
and a willing and an educated seller, right?
So,
You don't have to go through that process of helping them understand that their property is worth what it is.
yeah, for a while, though, I would say there was a pretty big bid-ask spread where they were holding out for this number, even on the institutional side. And I would say in the past 12 months, 18 months, people have adjusted to the new reality. And I think that means a good thing for brokers and for other people where things will
deals get done.
Exactly.
Good. Well, last nugget, I guess, whether it be for somebody who wants to get on the principal side or some nuggets of advice for brokers out there who want to do business with companies like yours, what are your thoughts?
Nugget advice. I would say it's always take a chance. I mean, the worst someone could say is no, right?
Mm-hmm.
I think one of the things that I've seen is people that's just succumb to this, and it could be a mental thing or like a fatigue of trying to pursue something, but like, oh, they're never going to do that. They're never going to do this. But like, and we've seen instances where it's been the opposite. Where the moment that I guess it's just be persistent.
Yeah.
And the fact that like you're so close to this and I've seen instances where they've been persistent and all of a sudden they're like, well, I don't know if it's worth it to do it, my time. Sure. And all of a sudden that's the moment where it happens.
Yeah.
Exactly. So persistency, and just reaching out. I ultimately it's just, I think the unique thing about real estate, it's very relationship and people driven. And so the better relationships you have with one another, it'll just help you in the long run.
Yeah. It's funny you say that because I agree. I think that, obviously, as you know, as brokers, we do quite a bit of cold calling.
Yep.
And we deal with quite a bit of rejection. And I remember a couple times, I'm working a list of potential prospects in the form of trying to get meetings and introductions and, essentially show them what the value is of our service. And I remember I'd be looking through my list and like, for example, this gentleman I have talked to, say 10 times over the course of 5 years, right? And every time the answer's been no.
Yep.
And you have that moment where you're like, should I pick up the phone and call him again?
Yep.
And anytime I came to say, nah, don't even bother, he's not, the answer's no. Like to your point that he's never going to do it. I remind myself, like, this is the business we got into. The business of what we got into.
Yeah.
The prerequisite was that you just don't give up.
Yeah.
And if I'm going to now start crossing people off, and there's always exceptions to the rule, but in general, if I'm going to make it a habit to cross people off and say this guy's never going to work with me, then I might as well quit. I gotta find a different job.
Agreed.
Yeah. So I 100% agree. It's there are a lot of ingredients that come into guys trying to build a successful career, a career that builds value for others as well. Not only people you work with, but your clients as well. But one of the main ones is certainly perseverance.
Absolutely.
So I appreciate you coming on.
Thanks for having me.
I had a lot of fun. You're a good friend, and I'm glad you agreed to come on and do this thing with me.
We got many more chapters ahead, my friend.
Love it. All right, man. Thank you for listening to Adding Value with Assar. We'll continue bringing on guests with stories and insights that matter in the world of industrial real estate. If you enjoyed today's episode, please share it with a friend or colleague. And if you're a landlord, tenant, or investor exploring opportunities in the Inland Empire, feel free to reach out to us. We'd be happy to help you navigate the market.